how to easily earn $100 extra on your dividend stocks using option selling. Now, I use two different strategies. I use covered calls as well as cash secured puts, and I combine them together. So we're going to get into this video and do a few examples of the strategy I use and how it can help benefit you. I'm Raylan. I'm here to save the world and make you wealthy, because everybody who is average, everybody who is a current or future millionaire deserves to be happy and wealthy. Now, there are a lot of people that are afraid of selling options, specifically dividend investors. And I have to tell you, I was scared of it first, but once I took that little leap of starting out with covered calls, I became obsessed, because it really is a way to supercharge your portfolio while you work. And if you are a real estate investor, it's kind of like renting out your shares. So I'm going to go over covered calls, selling cash secured puts, and using that in combination called the wheel strategy, just to go over some basics if you've been thinking about selling options on your dividend stocks or ETFs. So let's get into it. And I just wanted to share with you Webull. Now, I know a lot of people use Robinhood, which Robinhood is great. It's fine. I personally use Fidelity. You can't go wrong with Vanguard, Fidelity, or Schwab, so I normally go with them. Now, we're going to go with Kroger, ticker symbol KR. What I need to really pound the table on is Kroger is a boring stock. Let's face it. It's a boring stock that continuously goes up, continuously sees revenue growth and sales. It's a grocery store, and it's very well known in the United States. I absolutely love it because it's recession proof, and I say that because it puts pricing power on itself. And what I mean by that is that, so it has a price, but inflation goes all the way up, and we've been seeing inflation like crazy. But instead of the grocery store being like, okay, that's fine, I'll eat it up, it brings it on to the consumer. So its margins are not going down. It's in fact gaining revenue despite this recession and despite prices going up like crazy, because it is giving the prices over to the consumer. It's like, I'm not going to take care of that. You can take care of that. So it's one of those stocks that, like it or not, it's recession proof. And it's actually one of my favorite dividend investing stocks because it has a dividend growth rate of over 10% for the past 10 years. We love to see it. So we're over on Webull here, and we can see that if we go to the max, I like to start off with the macro. So overall, what has this stock been doing? It's been going up exponentially. It's been going up, and we like to see that trend line going all the way up. The first thing I do that is very, very important before we look at premium, before we look at how many dividends we can get, before we look at dividend yield, we want to see, is this company growing? Can I see this company in my portfolio? Is this a good company to own in the long term? We need to research like crazy. Do not ignore this. The boring work will make you wealthy. And Kroger is a huge example of that. It's a huge example of a very good, stable stock that is going to be around for a very long time. And you can squeeze as much premium, as many dividends, and as much capital appreciation, the trifecta, as you can once you learn these strategies. So now that we've researched, now that we're like, okay, this is a solid stock, I want to own it, has some nice dividends to it. We're like, okay, what do I do now? You sell a covered call. If this is your first time option selling, I would focus on selling covered calls first. It is one of the less risky option selling options, and it has a very good return rate. Once it is in our long-term investing strategy and we actually hold it for the long term, remember, we're thinking long term, we need to accumulate at least 100 shares. And for Kroger, it's at $49.16 right now. So it's going to take about $4,916 to purchase 100 shares of Kroger. And you may be thinking, oh my gosh, that's way too much, or oh my gosh, that's crazy. I could never get that money, which That's fine. I understand that. But most of the companies that are high quality, they are within the 2,500 to 5,000 range to start off with for 100 shares. And another dividend grower that I own that's really good is ARCC, Ares Capital, which to get 100 shares of that, it's about $2,000. So that's a little bit more than half of that, which is nice. So if you're just starting off, I would diversify a little bit more, and I wouldn't just buy 100 shares of one stock. Once you're in a place where you can get 100 shares of, say, Kroger, then we can start layering on options. So the covered call strategy, we have our 100 shares of Kroger. You must have 100 shares of Kroger. Otherwise, it's going to be crazy risky and we don't want to tread in that water. There's lots of sharks in there. It's not good. So what we're going to do, we're going to go to our options. And I like doing this about a month out. So this is going to be March 28th. And you can see that Kroger actually has some open interest, which is nice. It's not the most volatile stock, which again is nice for a dividend stock. It's not so great for options, but you can see that there's about 1,000 to about 100 for the weeklies, which is great. Again, you're not going to get as much premium on this, so you're not going to get as much premium or income on this from selling covered calls on Kroger, just because it is a safer stock. It is a safer dividend and a safer company just because it does have that steady revenue and you don't see a lot of dips. So what I like to do, let's look at March 28th. You can do monthlies on this, weeklies on this. You can do out to 3 months, 6 months. You can do leaps on it, whatever it is, as long as you will have 100 shares. Now, this date right here is the date that you are going to rent those 100 shares out for. So you're like, okay, here's my 100 shares of Kroger, so I'm going to rent it out until March 28th. The next thing that I look at is the strike price. So that is what is in the middle line. If the stock goes up to, let's say, 55, that's the price that we would be willing to basically sell all of those 100 shares. And whatever your cost basis is, it's $5,500 minus that $49.16 times 100. That's how much you keep. But that is only if the stock appreciates up to the strike price of $55 and if you have a buyer on the other end that buys it. Because that doesn't always happen. It doesn't always get assigned, even if it is above the strike price. So I'm looking at 55. I would be happy to sell my shares at 55. The next thing I look at is the delta. This is basically how much risk you're willing to take. It says I have a 9% chance that these will get assigned. Anything, in my personal opinion, below 25% is good for me, is my risk tolerance. I am fine getting a delta of, let's say, 0.25 and under, because the more risk you have, the better return you have. So it's a balance between the two. Even if you have a 25% chance that you could get assigned, you can do something else that's called rolling calls if you really don't want to get assigned. But we'll talk about that in another video because that is another secret ninja trick. We're looking at that 0.09. That's beautiful. I really like Kroger. I really do not want to get assigned. I just want to get some extra income. I'm choosing a delta that's very, very conservative. So the last thing I want to look at is our premium, how much we are getting paid to rent out those shares. So the bid is at $11, the ask is at $17. I would probably put this in for around $15. And then once those covered calls get sold, I would make, in that moment, $15. You get the premium right away when you sell options, which is beautiful because then you can go invest it into something else. It's amazing. You just get money right then and there. You don't have to wait for a tenant to pay you on the first. And then last but not least, we are going to just twiddle our thumbs, watch paint dry, or whatever you want to do. If you want to go off to the Bahamas or go to the beach every day, you just made $15 just to sit around and rent your shares. It's a nice payday. But what if you're like, oh my gosh, Raylan, I do not want to buy Kroger at $49.16. I want to buy it much lower than that because my value for Kroger, that's way overvalued for me. I think a good valuation would be around $40. So you would do the second strategy, and that is selling cash secured puts.